Hello, everyone. Dave Landry here from DaveLandry.com. This is Trading Simplified. So, what are we talking about? Well, I want to continue to talk about surviving and prospering during a bear market. And when thinking about a title for this presentation, it's You Can't Handle the Truth. And that'll make more sense in just a few minutes. I have a mystery chart follow up, which is riding the trend higher, at least until this morning, that was. Laugh to keep them crying. In this market, following something higher, that's kind of hard to believe, and I'll show you that in just 1 second and flesh out a few things there. I do have a couple of more mystery charts to show you. One I will reveal, and one will remain a mystery. Housekeeping, I do take requests. If there's something you want me to cover, let me know. Send it to davelandry.com/contact. It makes my job a lot easier. If I can't cover it in this venue, which is somewhat limited, he tried to say, and it's also recorded as opposed to live. I do a live show on Thursday nights. That's Dave Landry's of the Week in Charts. You can register at davelandry.com/webinar. If you want the slides from this presentation and every other presentation that I've done, I think it's probably, maybe 100 shows. That's crazy. Go to davelandry.com/StockCharts. I'll also give you all three of my books in PDF format and a bunch of other stuff to keep you busy. Also, a free market timing course is thrown in there and a bunch of other goodies. All right, let's talk about the mystery charts and the methodology in action. Here's a mystery chart for today, Tuesday, March 8th. It's DG, nice downtrend there, followed by a pullback. And here's a setup. This is a snapshot from today's trading service. DG sells short, 203, entry, 219 stop, IPT of 187. So that's what that looks like. You can see it triggered this morning, and so far it's reversed from there. But I still think it's a viable setup if you're looking to short this and short below today's low. I do own puts on this, full disclosure. Anyway, IPT is down here, and the stop, just in case we're wrong. Now here's our mystery chart for this week. As you can see, it's in a nice longer-term downtrend. It's pulled back from that downtrend quite nicely. And the parameters are right here, sell short at 52, stop at 58, initial profit target at 46. Let's see what that looks like. 52 is entry, nice liberal entry just in case it fakes out. Stop will go up here just in case we're wrong, and then initial profit target right down here below the old low. So we'll see how that shakes out. And as I'm looking at this, if you squint your eyes, you might be able to actually see what the symbol was on that. All right, let's take a look at KLXE. This is a former mystery chart. In fact, I actually revealed it while it was still a viable stock, meaning that it triggered but came back in, but still looked pretty good. Anyway, here were the original parameters. The 1667 shares are based on a 100K account. You can see it made a bow tie back here. It pulled back and pulled back a little bit, as you can see. Entry was here. Stop was down here. Initial profit target right here. And it took a little while, but it finally got to that profit target. And when that happens, the stop goes to break even. Go in and watch the shows we've done on money management, or go behind the firewall on my website if you have a gold membership and take the money management module. But anyway, this is the setup. Now you can see it did stop out in a trailing stop because the trailing stop was brought to break even, but I was able to apply a little discretion to it, and some of my clients also did. I feel bad using this example, or feel kind of bad, I should say, just because it might be rubbing salt in certain clients' wounds, but if you're newer to trading and you were following everything mechanically, that's completely fine. As you get a little bit more advanced, applying a little discretion can help you out longer term. So here's the actual trades. As you can see, in this particular account, I decided to trade 3,000 shares. And you can see I flipped out at the IPT, and then I also flipped out some more, taking partial profits, additional partial profits. So right here, by flipping out half, I made 17.10. And then the market was up big on this particular day. I figured it was worth lightening up a little bit. So out of those 1,500 shares left, I took 500 off. And then that was a profit of $2,566. And then when I was putting the slide together this morning, it was worth about 54.80 open. And then it went up a couple of points, and I was pretty excited about that. But then it's since come back in, which is a bit of a bummer, but hey, comes with the territory. So we'll just continue to follow along with this one. Reason I want to show you this one was twofold. A little bit of discretion can really improve performance, and I'm going to show you how I applied a little discretion here, although there might have been a little bit of luck involved, and I'll explain that too. And even when things aren't going quite that well, occasionally you can find some strength, and more importantly, you can find some setups. Now, they've been a little few and far between. If we have time toward the end of this presentation, I'll flesh it out a little bit more. If not, I'll pick it up in upcoming presentations. So here's a 1-minute chart of the day it stopped out. It opened higher. I do remember checking my screens and feeling like, okay, this thing looks great. Let me focus on everything else. The whole market had kind of come unglued overnight. I remember coming in short futures, and then I was scrambling to cover to make sure I was able to lock in some really good profits on the open. And I seemed to notice that this thing had slid past the stop. But by the time I got around to doing anything, the spread had widened out on it significantly. So I realized I'd have to trade out of it. And before I knew it, it had begun to rally, and I was able to stick with the position. Now, again, a couple of my clients did stick with it. And some of those who stopped out, if they're following things more mechanically, that's absolutely fine. Longer term, I would encourage you to learn how to use a little discretion with your trades. Of course, once you get a little bit more discipline and experience. And one more point, when I have open profits and I've already taken partial profits, I'm a little bit more lenient with the second half of the trade. I'll actually let that back up a little bit into the negative column as long as I can be profitable overall when I do stop out on the position. Last summer, when the market was making new highs on, I believe it was August 25th, 2021, I decided it would be a good time to talk about market timing. And I called that presentation Before the Bomb Goes Off. And the reason I called it that is because friends and family tend to call me up once they're down about 30% on their portfolios or more, in a bit of a panic, asking me what to do. And that puts me in a very difficult situation, as I've said ad nauseum, because it's kind of damned if I do and damned if I don't. If I tell them statistical things such as, well, the market occasionally loses half its value, so you could lose another 20% or more, they don't want to hear that. And if they decide to bail, of course, that might be the exact low. But instead of waiting to put yourself in that situation, learn a little bit about market timing long before the bomb goes off. Because once the bomb goes off, it's too late. So anyway, I did this presentation back when the market was at all-time highs, and I pointed a few of my friends and family toward that presentation. And I doubt that anybody bothered to watch it. Now, this got me thinking, based on the way I'm seeing people act recently, about the fact that you have a cognitive bias that might be keeping you from seeing what actually is. And that'll make a little more sense in 1 second. But from a psychological standpoint, if you want the truth, you might not be able to handle the truth. So where am I going with that? Well, it'll make more sense in just a second. But as I showed in prior weeks and last summer, I believe, memory serves, once a market drops more than 10% from its 50-week moving highs, once a market drops more than 10% from its 50-week closing high, there is a potential for the market to worsen even further. And as you can see, we've got some 20% drops in here, some 50% drops in here, and of course, an 80% drop in the Great Depression. And by the way, you might be thinking that was then, this is now. Well, the NASDAQ lost half of its value in 2000, and then it lost half of its value again. It was 70-something% total, but it was a pretty ugly slide. Anyway, here's the pandemic slide. As you can see, 30-something%, which means obviously it dropped another 20-something% after dropping 10%. Now, one thing to point out, especially if you are a longer term investor, so to speak, and you haven't lived through a couple of bear markets, remember, just because you haven't lived through something doesn't mean that it can't happen. And I've lived through a couple of bear markets, and I've seen the markets lose over half of their value. As I say quite often, markets go up and markets go down. And whenever I say this, people look at me like I pooed my pants, you know? But when markets go down, they begin reasoning why they shouldn't go down. And they begin fighting it. Now, I work out with a couple of friends of mine, and I did tell them last summer to watch the aforementioned presentation, and I doubt that they did. And at one point, a few weeks ago, when I noticed that we had this sell signal in the market, I pointed out to them that we had a sell signal. And I said, you know, you might want to talk to your guy. And he said, I talked to my guy, and he said, I did. I said, oh, what did he say? And he said, well, he said that we're going to get more aggressive now that the market is dropping. And I'm a very emotional guy, and I tend to wear my feelings on my sleeve. It's like I can't go in the house from my office when I'm having a really bad day and my wife not know it. You know, I'm very easy to read when it comes to emotions. And I must have scoffed or rolled my eyes or something, and he immediately got a little defensive with me, and he said, hey, my guy has made me a lot of money. And I said, well, I think the market has made you a lot of money. Thinking to myself, this guy is obviously a buy and hold type of guy. And that just got me thinking, nobody wants to hear that the market can occasionally go down. Now, as I often say, my mother-in-law, she never asked me about the markets like back last August when it's making new highs. She waits until we're in the middle of the family dinner and the market is in a bear market, and she says, what do you think the market's going to do? I'm like, well, looks like we're in a bear market. And she's like, you're always a bear. So it's like, well, stop asking me about the market once it's down 30%, you know? Anyway, one thing I preach quite often is to believe in what you see and not in what you believe. And this dovetails nicely into the cognitive biases that I want to touch upon today, or, and it's for purposes of this presentation, what you want to believe. One thing I talk about quite often is when you're looking at a market, and let's say the market is going down and you're long, you tend to see a little bit of a bounce as something much bigger than it is. You might think to yourself, oh, this was just a correction, the correction's over. Now the market's going to go back up, as it does longer term, right? The market goes up longer term. Well, that's based on an 81-year time horizon, but who's counting? One thing I love to do is read books that are at least 100 years old when it comes to the stock market. And I found this little Psychology of the Stock Market. I recommend you read this book. It's a quick little read. It's in public domain if you want to just get off the internet. But I have several copies and a Kindle copy, and it's just I have quite a few copies of this, and I've read it probably a dozen times. And it's interesting. Some of the things that he's touched upon, and again, this thing was written over 100 years ago, is things such as the fact that there's a neurology involved with trading. The average man is not blessed or cursed, however you may look at it, with an analytical mind. We see as through a glass darkly. Our ideas are always enveloped in a haze, and our reasoning powers work in a rut from which we find it painful, if not impossible, to escape. Many of our emotions and some of our acts are merely automatic responses to external stimuli. Wonderful as is the developing human brain, it originated from an enlarged ganglion, and its first response is still practically that of the ganglion. There's a lot to unpack here, and what he's hinting at is the lower brain, the caveman part of our brain, the so-called lizard brain, because it looks like a lizard brain, the amygdala, and all that stuff that's sitting underneath the rest of what's sloshing around up there that makes you. Your conscious brain is on top of all that. And we are emotional, and that lower part of our brain drives us quite a bit. And it makes us make these emotional charged decisions. Now, the point is, we all see things through a perception prism. We don't see things as they are. Like I said a second ago, if you're long, you might see a market differently than someone who is short the market or not in the market at all. And as I said before, whenever I'm speaking, especially in person, I'll ask the audience, how did you guys fare during the cocoa market, bear market that we had a few years back? How stressful was it? And not one person in the audience had a problem with it. Well, that's because they weren't active participants in that market. Now, maybe one day I'll bump into a cocoa trader and he'll feel differently. Socrates was mentioned in the G.C. Selden book to make the worse appear the better reason. So instead of believing in what you want to believe in what you see, or just play devil's advocate. And it was interesting that Selden wrote the Socratic method applied to the average speculator would produce amusing results. And initially I thought he said amazing, but amusing is an interesting way of putting that. Now, this all kind of dovetails in with cognitive biases, and that's the problem that I think a lot of people are having right now is they're succumbing to these cognitive biases. And a cognitive bias is mistaken reasoning, evaluating, remembering, or other cognitive process, often occurring as a result of holding on to one's preferences and beliefs regardless of the contrary information. Amen. My friends who are holding on for dear life and the guy that's telling them to hold on for dear life, okay, sounds like they both have a little bit of a cognitive bias. Getting back to the G.C. Selden book, few persons are so introspective as to be able to tell where this bias in favor of their own interest begins and where it leaves off. Still fewer bother to make the effort to tell. Optimism, then, must consist in believing not that the tide will continually flow your way, but that you will succeed in floating with the tide. Your optimism must be, in a sense, of the intellect, not of the will. An optimism based on determination would, in this case, amount to stubbornness. Now, I like this definition of perception, the second one, that is, interpret or look on something or something in a particular way. And we're all guilty of selective perception and perceptual distortion. So with a confirmation bias, our perception of what is isn't always what is. With selective perception, we tend to agree with information that agrees with information that supports our position. So you're short a market, it begins to uptick, you think, oh, it's just an uptick, let's not get too worried about it. Or as I showed earlier, if you're long because you're a longer term buy and hope type of person, smoking the hopium, I'm not making fun of anyone because it is a sad thing when the market goes down and people just write it down. But when you are long like that, you definitely have a bias. The other thing is you could use a little perceptual distortion. Maybe that little bit of a rally is just that, a little bit of a rally, but in your head, it's much bigger than it really is. You must separate yourself from the market. I know, haha, easier said than done. If you're long or short of the market, you are not an unprejudiced judge, and you will be greatly tempted to put such an interpretation upon current events as will coincide with your preconceived opinion. Mark Douglas, my brother from another mother, we are not perceiving the market, but only the unique market in our minds, okay? Did cocoa stress you out? Probably not. Based on the distinctions we have learned up until this moment in time, the market has no control over how you behave or respond to it. It's all in your head. Well, I dropped quite a few F-bombs this morning. Don't confuse the issue with facts. Unless you're Bill Clinton, what is. The market is doing what the market is doing. The price of the instrument, the ask, is the lowest amount that someone will sell it to you. And the value of the instrument, the bid, is the lowest amount that someone will pay you for it. And that's another one of those duh type of things. But you'd be surprised at how many people will justify price that is simply not there in the actual market. You might not like it, and statistically, the chances are you won't. I've done complete presentations just on this. More often than not, you are in a drawdown. And again, there's a lot to unpack there, but just take my word for it. If you've been trading for more than a day, you probably understand that. So statistically, you probably won't like what's happening more often than not. But whatever is. If you have to get out, you have to get out. One of the greatest difficulties encountered by the active trader is that of keeping his mind in a balanced and unprejudiced condition when he's heavily committed to either the long or short side of the market. Unconsciously, to himself, he permits his judgment to be swayed by his hopes. I love the flowery language they use in these old books. So I had to look up sophistry because it doesn't seem like a word that's used that often. The use of fallacious arguments, especially with the intention of deceiving. The market is relentless. It cannot be budged by our sophistries. It will respond exactly to the forces and personalities which are working upon it, with no more regard for our own opinions than if we could vote. We cannot work for our own interests as in other lines of business. We can only fit our interests to the facts. To make the greatest success, it is necessary for the trader to forget entirely his own position in the market, his profits or losses, the relation of present prices to the point where he bought or sold, and to fix his thoughts upon the position of the market. If the market is going down, the trader must sell, no matter whether he has a profit or a loss, whether he bought a year ago or 2 minutes ago. He's backing into a lot of things here. Sunk costs, where you buy a market, is not relative to where you might have to exit a market. The endowment effect, the longer you own a stock or the longer you're in the market, the more you will have a harder time getting out of the market. So he's really backed into a lot of neurology and psychology here. He can endeavor to hold himself in a detached, unprejudiced frame of mind and to study the psychology of the crowd, especially as it manifests itself in the movement of the prices. Now, one thing interesting is Roy Longstreet once said that sometimes the market itself can make a mistake. I've never fully wrapped my head around that, but the longer I've been trading, the more I'm beginning to slightly understand it. Okay, let's take oil prices today. They're beginning to implode. And there's no reason why they should be imploding today other than maybe they're overbought and people are taking some profits, or the Johnny-come-latelys got in a little too late. But maybe the market's actually making a mistake. But that doesn't matter. If you're long and you need to exit, you need to exit. The deepest secret for the trader is his ability to subordinate his own will to the will of the market. He wrote a book called, Longstreet wrote a book called Viewpoints of a Commodity Trader. It's a really good book. I gave away my copy, then I later found out, because I figured I'd just pick up another one. I later found out it was a rare book, but you can get reprints of it now. And I'd recommend you read that one too. Annie Duke wrote Thinking Your Bets. Good book. Instead of altering our beliefs to fit new information, we do just the opposite. Alternate our interpretation of that information to fit our beliefs. Amen. So how do you overcome these cognitive biases? Well, make the trade bigger than you. Try to see things as they are and not what you want. Be Socratic. What could go wrong? Why does a person on the other side of the trade think that he is right? Be accountable for your actions. And if you feel conflicted in all this, something's wrong. Now, there's quite a few more things I want to pick up on with this, and I'm going to continue this conversation on Thursday. If you go to davelandry.com/webinar, once again, you could register for that webinar. If you need follow-up information, again, davelandry.com/StockCharts. If you need to reach me, davelandry.com/contact. I want to thank everybody for watching, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.